Behind the Built Environment, the podcast from BESA, the UK's leading trade body for the building engineering services sector.
Hello, I'm David Frise, Chief Executive of BESA. Welcome to Behind the Built Environment, the podcast where I delve into the major issues facing our industry through in-depth conversations with key industry leaders. Join us as we explore the trends, challenges and innovations shaping the future of the built environment. Our guest today is Noble Francis. Welcome, Noble. Noble Francis is the Economics Director at the Construction Products Association, the CPA, where he leads a team of economists responsible for the organisation's highly regarded quarterly construction industry forecasts, state of trade and construction trade surveys, and bespoke research analysis for the built environment sector. He holds a master's degree in economics and a PhD in applied econometrics and brings over 15 years' experience in economic forecasting and analysis. In 2018, he was appointed Honorary Professor at the Bartlett School of Construction and Project Management at the University College London, marking the recognition of his academic and industry research work. In 2018, he was appointed Honorary Professor at the Bartlett School of Construction and Project Management at University College London. His commentary and research are regularly featured in major trade media, national outlets and broadcast media, underscoring his role as a go-to expert for economic insight into the construction and building engineering markets. So, welcome again, Noble. Very pleased to have you here. You've seen these podcasts before, you know the format, and we like to start off with some 5 yes-no questions, please, to set the tone, set the agenda.
Indeed.
So here we go. Question 1. Is the UK construction sector heading for a recession in 2026?
It's going to be a challenging year.
Yes, no. Yes, no. Thank you. Are bond markets now a bigger risk to construction than inflation?
Yes.
Has AI investment already started to distort capital flows in the built environment?
Yes.
Is the industry's capacity crisis more about people than products?
Yes.
Can the UK construction sector realistically hit net zero targets without major policy reform?
No.
Great. It's always more difficult than you think doing that. The next thing, before we really start the detailed questions, was really, how did you end up in this career? Did it choose you or did you choose it?
As with many people, I accidentally fell into construction. So, as you surmised at the start, I started doing economic research, master's degree, PhD, thought I'd go into the finance world, and suddenly realised after working in commodities research how incredibly boring it was. So moved away from there and started working in consultancy, doing economic research again, but for consultancy. And consultancy was incredibly painful. But one of the areas that I did work in was construction research. And so we started doing construction employment forecasts for CITB. We started doing construction inflation forecasts. This is looking back to around 2006, because we were doing construction inflation forecasts for the government, a department called the Office for Government Commerce, because at that point in 2006, government was worried that with all the construction it was going to be doing for the Olympics, if it was going to do that at the same time that private sector was going to be building everything it was going to be building for the next 5-10 years, would you end up with big construction inflation, capacity issues, and would they be able to finish the Olympics in time? And as it turned out, private sector had the biggest financial crisis in 35 years, which sorted that problem out. But one of the things I learned doing construction employment forecasts, construction inflation forecasts, is how incredibly complex and interesting construction is and dysfunctional because of that research. And of all the industries that I did research in before, construction is the most fascinating and dysfunctional of all the industries, because we talk about construction as one industry, but it's not. If you're working on national grid capacity upgrades, then you have no interest in what Persimmon, the house builder, is doing. If you're working on roads construction, it's nothing to do with what commercial office fit out and refurb is. So construction isn't one industry, it's 30 different industries all combined, and that's what makes it fascinating.
So you mentioned the forecast, your quarterly forecast just been published?
Yes, they were published on the 27th of October.
So this is very prescient. Can you give us the headlines from that? What are you expecting in the next year?
Our forecasts cover 30 different sectors and subsectors of construction and the UK economy, and they're 134 pages. So
we need the briefest bit.
Summarising that in the space of 2-3 minutes may be challenging, but essentially you have a situation where the UK economy is muddling along. We're looking at 1.1% growth last year, 1.3% growth this year, 1.5% growth next year. And given that long-term average growth for the UK economy is 2% per year on average, that's not great growth. You're also looking at a situation where government is looking at tax rises and potentially spending cuts, which doesn't bode well for the economy, but also for our industry, given that we're heavily reliant on capital investment from government. Government is the largest client in construction by far. So looking at our forecasts, you're looking at very mixed fortunes over the next 12, 24 months, and it heavily depends which sectors you're working in, which sectors you're feeding into. And we talk to firms all through the supply chain, not just the big contractors, not just the major house builders, but we talk to architects, cost consultants, major contractors, major house builders, smaller specialist contractors, builders merchants, product manufacturers. And what's apparent is that there are some sectors that are doing incredibly well and likely to do incredibly well over the next 2 years, 5 years, even 10 years ahead. So you're looking at very bright areas of commercial refurb and fit out, changing the use of existing commercial buildings into residential, if it's in the middle of cities, or if it's on the outskirts of cities, industrial properties. You're looking at data centers, gigafactories, very strong. You're looking at energy infrastructure as a very big growth area, double-digit growth every year. And that's whether you're working on nuclear power stations or wind farms, but national grid capacity upgrades long-term is going to be absolutely critical. Data centers, gigafactories, all big growth areas, short-term and long-term. However, that's great if you're working in those supply chains. But if you're working in new house building, if you're working in housing, repair, maintenance and improvement, it's a very challenging market out there. You've got uncertainty for home buyers, uncertainty for homeowners. You've got uncertainty for businesses because they don't know where the tax rises from government are going to hit. You've got uncertainty from investors and from clients, particularly on bigger projects, bigger developments. And then from some sectors' perspectives, they're obviously impacted by the building safety regulator, particularly high-rise residential, student accommodation. And so even where the demand is relatively strong, as it is in student accommodation, you've still got struggles getting on site and getting the work done, and you've still got nervous investors there because you've got 6 to 9 month delays at Gateway 2 stage for the building safety regulator. You've got 3 to 4 month delays at Gateway 3 stage. And those initially impact construction activity, but then medium term, they make investors more hesitant.
We have a much anticipated budget in the UK coming up shortly, and I don't want really to speculate on what that might deliver. But why is it that the UK bond markets currently are under more pressure than those in other advanced economies? And what are the underlying economic or policy factors at play here? And why does that constrain what the Chancellor may or may not be able to do?
Okay, I mean, there's two things. Firstly, it's worth taking the context that longer term, all Western economies have certain issues when it comes to public spending, public borrowing, and there are long-term issues about where the long-term growth is going to come from. There's a problem long-term with productivity growth. There's a problem long-term that demographic changes, older people living longer, fewer younger people coming through because of lower birth rates, mean that you're going to have a smaller workforce as a proportion of the population paying for a larger number of older people who will be taking out of public spending. So there are long-term issues that are affecting all Western economies. Then you bring it back to the UK, which is your question, why are we particularly affected? We're particularly affected because we have the long-term demographic issues. In particular, we have an issue that we had a new government come in July 2024, coming in saying that it was very pro-growth, pro-productivity growth, pro-business. Driving growth was critical for the new government, so they said. And then the first thing they did was raise taxes because they are keen to stick to self-imposed fiscal rules because they want to show the financial markets that they are a credible government. And that's all very well. The problem is that their view was to increase taxes on businesses on the basis that they would be sticking to their fiscal rules and they would be funding capital investment growth by cutting social care and cutting civil service, two key areas of day-to-day spending to fund investment in construction, infrastructure. That's all very well. However, very quickly after they announced that, they found that businesses became risk-averse from the increases in employers' national insurance, and that is not helpful for growth. It's not helpful for productivity growth. You also found that government struggled to get its social care cuts through, and cutting civil service may occur long-term, but short-term that hasn't happened. So the financial markets are concerned about whether the government's plans to stick to its fiscal rules and have a balanced government budget by 2029 are credible. And if you lose credibility in the financial markets, you end up with gilt rates going up, you end up with lending rates going up as a result of it. And that's absolutely critical when it comes to home buyers wanting to borrow to buy homes. It's critical for businesses to be able to borrow. It's critical to investors who may want to finance large projects.
The OBR downgraded UK productivity by 20 billion, which I'm sure the Chancellor was delighted to receive just before her budget. Her immediate response was to blame the previous government and Brexit. First of all, did we know about the downgrade in productivity in advance? And secondly, is she right about blaming the previous government and Brexit?
Good questions. The productivity growth we knew was going to be an issue because productivity growth has been relatively poor for quite a long time now. The Office for Budget Responsibility were a bit over-optimistic as ever regarding what productivity growth was going to be after the last autumn budget and the extent to which government's capital investment and its planning reforms would help improve productivity growth, and the time lag between making policy changes and them having an effect is a lot longer than expected. So we knew there were going to be productivity growth downgrades. The productivity growth downgrades that will occur from the Office for Budget Responsibility are larger than the financial markets were expecting. And so that means that the amount of headroom that the government has in the budget is less than was expected, and it wasn't expected to be great. So you're going to find in the autumn budget that the government will have to find 20 to 30 billion extra compared with in the spring or in last year's autumn budget. And That either comes out of tax rises or spending cuts or both.
Presumably the OBR are not on her Christmas card list this year.
Indeed, which gets back to your original point, which is whether that was due to Brexit or due to the previous government or both. And a part of it is the lag effect of Brexit. A part of it is the lagged effect of previous governments, and we've had quite a few in recent years. But a part of it is actually due to what's changed in the past year or so as well. So it's a combination of those. The problem for the government is that they came into a government very positive, with a lot of positive intent, saying that they were pro-business, pro-growth, pro-productivity growth, and then the first thing they did was increase taxes on business. Growth has been much slower than expected and is likely to be over the next 12 to 24 months. And so purely blaming Brexit and the previous governments may have played better with the public if they'd said it from the start. But unfortunately, if you don't set the expectations when you come in as a government, then you can't change the story a year and almost a year and a half later and then expect people to believe it.
So not unrelated to productivity, AI. Let's just move on to that briefly. Now, worldwide, a third of all capital investment is in AI.
Yeah.
Are there risks in that? And B, if there are risks, what could go wrong and how would that impact construction?
Okay, I mean, let's take the positives first, which is that if you look long-term, economic history-wise, we've been searching for a new growth model. And we had, going back 200 plus years, you had the movement from agriculture to manufacturing. More recently, you had the move from manufacturing in Western economies to financial services and services more generally. So financial services, business services, and so on. Last 10, 15 years, post-financial crisis, we've been looking for a new growth model, and we've been looking at net zero, which will provide some growth, but it's not a panacea. It's not a cure for everything, and it won't generate the growth that would have been anticipated 10, 15 years ago. But it will provide growth in some areas. AI has rapidly come on the scene in the last 2-3 years. It was there in the background a few years before, but the last 2-3 years it's come. And as you say, it is attracting investment from everywhere. And it has a lot of potential long term, a lot of potential in those areas where internet search engines are not as useful as they were 10, 15 years ago, a lot of use in those areas of services where a lot of jobs are process-based already. Some areas of construction, it may have some benefits, others not so much. In terms of the dangers and the risks, the key ones you're looking at are the fact that at the moment, investment money is going from all sources into AI. As you say, 1/3 of all investment money is going into AI. At the moment, the majority of AI companies are not making money. And at some point, investors will be demanding a return on those investments. And if you look at the example of internet companies back in the late 90s, we had investment money from everywhere going into internet companies. And most of those internet companies were not making profits in it initially. And in 2000, 2001, we had a consolidation and we had the dot-com bubble burst. At some stage, there will have to be a consolidation of AI companies. There will have to be a rate of return for all this investment that is going into AI. And what we don't know, because it's only been 2-3 years that we've seen this mad rush of AI and tech investment generally, we don't know whether that consolidation is going to occur in 2 years, 4 years, 6 years, 8 years, or 10 years.
It's fascinating, the whole area. I mean, and they are busily investing in each other, so they're so interlinked. And I read this week that they need $1 trillion of revenue to get to break even. One thing, the difference between $1 billion and $1 trillion is significant, isn't it?
It is very big. It's too easy to get caught up in large numbers. And the example I use with my students is that 1 million seconds is over in 11 days. 1 trillion seconds is 32,000 years.
So
millions, billions, trillions makes a big difference.
yeah,
And we as humans, and this is more a psychology point than anything, but we struggle as soon as numbers get to a very large extent because we can't visualize it.
no. Before the pandemic, 1 billion was an awful lot, and now it's nothing. And 1 trillion is the new. Get your head around that, as they say. Talking of other investments, so in the UK in particular, but actually I think worldwide, private equity is really increasingly interested in building engineering and specialist contractors. What's behind this surge in interest, and what does it signal for the future of ownership and control in the sector, do you think?
I think what you see from private equity diving into building engineering services firms is that that's where long-term there are key returns to be made. Not just returns over the next year or two, but we've seen building engineering services become an increasing proportion of the value of construction projects over the last 10, 15 years. And it's only going to become more important over the next 10, 20, 30 years as we see energy efficiency come in more, not just on the residential stock, but on commercial building stock. We have minimum energy efficiency standards for commercial building stock, and 70% of buildings, not just in London, but outside of London, are below those minimum energy efficiency standards. And some firms will have to do that work. We probably won't meet the deadline, but building engineering services, particularly on the energy efficiency retrofit side, are going to be absolutely critical and increasingly more important. And even within new build projects, not just on the commercial side, but even when you look at things like infrastructure projects, you look at Crossrail, then you look at smart technology accounting for a larger proportion of that project. And one of the main reasons it went over budget and over time was the struggle to do the smart technology towards the end of the project. And so what those private equity firms are seeing, because they're not stupid, is that long term, that's where the returns will be.
Let's hope so. You described at the beginning, and construction was an industry of, I think you said 32 different types of industry there. In some areas they have real capacity issues. In those larger infrastructure projects or NHS new build projects. What are the root causes of that, and what realistic steps can be taken to resolve it, do you think?
Long term, we've always had an issue around skills, which is an aging demographic within the skilled trades element of construction. So I've been banging on for the last 10 years about the fact that the majority of the UK-born workforce in construction at the skilled trades level was between 50 and 64 years old. And that was since 2014-15, I've been banging on about that. And so what we've seen the last 10 years, but especially since the pandemic, the last 5 years, we've lost over 280,000 UK-born construction workers. And it's not just the number of people, it's the skills and the experience there. So that aging demographic has always been an issue of the last 10, 15 years. You combine that with the fact that we don't do enough to get new entrants into the industry, and when they're in the industry, upskill them and do career development, then long term you're building up a problem. And we're increasingly going to be facing those issues. Short term, they will be, as you suggest, in those areas where activity is strong, so commercial fit out and changes in use, data centers, gigafactories, big one-off infrastructure projects. But then longer term, we're going to face that issue across all parts of construction, given that we're anticipating that house building will recover slower than we would hope, but it will recover, given that we'll need to retrofit the house building existing stock of around 17 million out of the 29 million homes in the UK, given that we'll need to retrofit 70% of the commercial building stock, given that we'll need more and better quality infrastructure, given that we'll need more hospitals, more schools, more military and defence spending, more prison capacity. The key issue is going to be long-term, where are we going to get the skills to be able to build all this?
Are the business models wrong? I mean, highly fragmented industry, huge amounts of self-employment. Is that the wrong model for building a skilled workforce?
It's the wrong model for building a skilled workforce, but it's the right model to deal with the volatility in demand. So if you take one extreme, which is private house building, and major house builders build 3/4 of homes in this country, then once every 10 years, house building completions fall 20 to 30%, once every 10 years. Private housing starts fall 60 to 70% once every 10 years. Now, if you want to deal with that volatility in demand, what you don't do is employ directly and do lots of investment upfront in skills, capacity, more efficient methods. What you do is subcontract out the cost, activity, and risk. So when you hit a downturn, you can deal with that as a major house builder. However, what that means is lots of small firms go under and lots of self-employed people get made unemployed. Look at other areas. If you look at infrastructure, you don't have the cyclical issue, so you don't hit a financial crisis. But what you do is face a situation where government cuts spending when it's financially, fiscally constrained. So it effectively acts similar to private sector. So it exacerbates the problem. And when you look at infrastructure big one-offs, then it will, instead of doing a steady pipeline of projects, which will allow major contractors the stability in demand to be able to invest in skills directly and employ directly, you end up in a situation where the last nuclear power station we did was Sizewell B, which finished in 1995, and then nothing until Hinkley Point C started on site in 2016. So you're looking at 21 years, in which case, who can justify investing in skills and capacity if you've got a 21-year hiatus in projects in an area where the skills are very specific? And the same occurs with high-speed rail. It's not just one anecdotal case. It occurs across everywhere. And high-speed rail, we did HS1 and then nothing for 11 years until HS2. And so unless you have that stability in demand, the business models for the main contractors who win the projects or the business models for major house builders will always focus on subcontracting out the cost, activity, and risk, because they understandably don't want to go out of business when there's a recession or when there's a hiatus in big one-off projects.
I'm going to go back to productivity again now, because it's a long-standing challenge to the construction industry. In your view, what are the most effective levers we could pull? Is it technology? Is it things like AI? Is it procurement reform? Is it skills investment? How do we change this dynamic?
Good question. I'll take this from short term and long term. Short term, what you want to do to get productivity growth is look for the quick wins. And if you look at major house builders, you look at major contractors, they will tell you, yes, we've got lots of dashboards and presentations, and we talk all through our organization at how we can improve productivity, which is very nice, but they're not the ones doing the activity on site. If you want the quick wins in construction, what you need is full collaboration with the whole supply chain, because the ones on site who can tell you where the quick wins are the specialist contractors, because they're the ones actually doing the work. And they're the ones that they can tell you, look, if we do it this way, we'd actually get it sorted quicker, better. we wouldn't have to repeat as much work. And that's where the quick wins are. Now, that's lots of little, small things which are quick wins. And what you need to ensure for the next project is that you learn from those quick wins. They're the small practical elements. When you're looking at where the bigger long-term productivity benefits come from, then what you require, unfortunately, and I always take it back to a stable, consistent demand and a long pipeline of projects, if you provide a long, consistent pipeline, relatively stable demand, then the major companies in that sector, whether it's major contractors operating in commercial or infrastructure or major house builders operating in private housing, if you provide stable demand or at least minimize the volatility, then they can justify the upfront investment, which is where you get those productivity improvements from. That is investments in skills, not just training someone to do one particular skill trade, but you train them to do a skill trade and then you upskill them and give them career development. Now, if my business model focuses on subcontracting out all the cost, activity and risk, I'm not training them to do upskilling, reskilling, career development. I just need a particular trade to do a particular job on this particular project. I'm not interested in anything else. So, more stable demand allows investment in skills. More stable demand allows investment in capacity, and capacity across all areas. Capacity in better delivery teams, capacity in better planning teams. So you're not rushing to site to start the project and then have to pause whilst you work everything out. Capacity in terms of materials and products as well. All of this requires stable demand. Then if you get that stable demand, you can also have improvements in productivity that come from large investment in areas such as tech. And that brings it back to AI in some areas, but also just improvements in the process, improvements in areas such as offsite manufacturing, which all require major investments up front. And you're not going to get that unless you have the stable demand.
Is the answer that actually to fix one thing, you have to fix pretty much everything?
There is a tendency within construction to look at each symptom as a separate problem that needs to be fixed, whereas it's not. You do need to look at the overall problem, which is the business model, and the business model is a function of the way procurement is done, and that would do a lot to address any of the issues. And those issues are whether it's productivity, whether it's skills and capacity, those are whether it's retentions or whether it's payment terms or any of this. All of these derive from the fact that the business model is there to suit the cost, activity and risk volatility and the way some major clients like government procure based upon cost rather than what should occur, which is procurement based on value rather than cost and long-term value, which would enable more stable demand. And then you can get the investment in changing the business models.
But doesn't the construction industry deliver pretty good return for investors? Therefore, there's no incentive to change because actually they're doing very nicely. Thank you.
They are, but is the client getting what it wants? And long term, if you are government, you have ambitions of more housing, more infrastructure, more schools, more hospitals, more prison places, more defence infrastructure. And then from a private sector point of view, we need more commercial building stock of a higher standard. We need more homes. We're not going to get all of this together the way that we're operating. And so long-term things will have to change, albeit we said that 10 years ago and 20 years ago.
To say that, no.
But we've always got away with it. And remember, from a skills point of view, we got away with it in the 90s with the cliche Irish builder. In the 2000s and 2010s, we got away with it with EU labour coming in. And one of the things you notice from looking at the age demographic data of construction employment is that not only have we seen a sharp fall in the older UK-born workforce since 2019 Q1, but we've seen a significant fall in younger EU workers, some of whom have gone home because of Brexit, but many of them have gone home because their major project has finished, and they usually go home after that big project has finished, but then they get replaced by new workers coming over from the EU. That's not happening. And so we may, as time goes on, reach a critical point at which we do need to address it.
The Japanese construction industry had a similar problem, did they? They simply ran out of workers. Did that drive innovation?
To a certain extent, in some areas of construction, Japan is a very different industry. So if you look at house building, then Japan builds around 150,000 homes off-site each year. And that's because they're not so invested in having homes that last for hundreds of years like we are. And if you look at the Japanese house building stock, only 3% of it is pre-war, whereas here it's 37%. And where we have traditionally built fewer homes, demolished fewer homes, and that doesn't lend itself towards a bigger volume house building market and off-site manufacturing. But the major house builders are aware that there are likely to be skills issues long term, and whereas in the past their business models always veered towards subcontracting out all the cost, activity and risk. And if you look even now, for the top 10 UK house builders, they only employ one person for every 3 homes they build. Virtually everything is subcontracted out. But most of the major house builders are looking at having around 30% of their new homes built by timber frame going forward. But they're unlikely to do more than that. But at least it's 30% timber frame, because they know a degree of off-site manufacturing will help them given the skills issues we're likely to face. And from their perspective, again, bringing it back to the business model, even if there is a sharp fall in house building of completions of 20 to 30% during a downturn, or private housing starts 60 to 70%, they can still operate the factory at 90% capacity utilization or more, and it's still viable.
You talked about the importance of planning. And at the moment, there are huge delays around Gateway 2, Gateway 3. But what they do make people do is plan, do they not? In the longer term, do you think that will derive productivity benefits through proper planning, proper design, right? So we don't rush to build and design. We are truly designing and building.
Potentially, yes. The Building Safety Act obviously applies to construction, not just to high-rise, but currently the Building Safety Regulator is focused on high-rise residential, student accommodation and some hospitals, buildings that are 7 stories or 18 meters and above, in which people are staying overnight. So that's a relatively small proportion of construction. The vast majority of construction is not guided by that sort of business model. If we are to change the way construction is done, then construction will have to move, particularly in areas like infrastructure, more towards planning in advance what is done, and then getting to site, not rushing to site and starting doing things, and then finding that you need to pause, delay, you need to do rework. And some areas of infrastructure have between 10 and 20% of the construction workers rework. And that's where your productivity problems are.
Sure. I need to move on. Is ESG-driven investment dead?
No. What you see with what was sustainability and what is ESG is that it morphs, it changes, and it's not dead because it's fully embedded within companies now. If you look 10, 15 years ago, then you had a sustainability team that was working on sustainability, And that was inputting into what the rest of the business did. Now, sustainability is fundamental. It's built into each area of what businesses do. Investors are concerned in some areas of whether they're getting the returns that they would have been hoping for 5, 10 years ago. But what they're not going to do is just pull away from ESG completely, because it's too broad an area, and there are some areas of ESG that are around changing the business model and around driving growth. It's not that it's a nice to have that costs money, but we'd like to have it. It's something that actually drives growth, and you need, if you're going to be winning those large contracts, whether it's with government or whether it's with private sector, and that's fundamental to the business.
And presumably risk mitigation for climate crisis.
Yes. I mean, not just climate crises, but remember, ESG covers a very wide range of areas, and what you can't be doing is facing issues that some companies face in different industry sectors, that their products end up being made by dubious sources of labour, shall we put it that way. And because ESG covers a lot of different areas, it's fundamental to what large businesses do in particular, because it actually does reduce your risk that you're exposed to. And ESG would be more at risk if it was just applied to one company. Because it's applied to all companies, then all companies actually benefit from it in the long term.
Great. Final question. So if you could change one government policy to strengthen the construction sector in the next 12 months, what would it be and why?
I'll be an economist and fudge this a bit, which is, rather than one government policy, what I would do as government is focus more on delivery and not on a constant stream of announcements for public relations. And I would also spend some resource getting construction knowledge and experience in-house, which is absolutely critical. Because if you're going to be setting the framework for construction, if you're the biggest construction procurers, you need to know construction, especially given that government is so focused on capital investment to drive productivity growth and drive growth in the economy, and given a lot of its targets are focused on more homes and on more infrastructure. Now, one policy is a more complex issue, because there isn't one simple policy that government can just turn the tap on and then it makes everything okay. But if I was to have one policy across government departments that would benefit construction, it would be that government doesn't just say that it procures on value and has its nice value matrices and its dashboards and its gold standard for procurement. My one policy would be government actually, take all the public relations out of it, actually procures on value and doesn't just procure on the cheapest or second cheapest.
Final question, which I ask everybody. And this one, probably the most important person I've asked so far on this, but are you optimistic or pessimistic about the future?
I'm an economist, so I'm realistic. The glass is not half full or half empty. The glass is too large for the amount of water that's there. I'm realistic.
Professor Noble Francis, thank you very much.
Thanks, David.
We believe that better buildings support better lives by representing those who are a part of the industry, setting the standard of excellence across the sector, providing opportunities to upskill and be competent with our training and courses. We help you be future ready, with the right accreditations to evidence your competence, win more work, and demonstrate your organisational capabilities. Be protected and grow your business to the next level, and be skilled and supported so you can focus on improving buildings for us all. Be part of the community. Be part of something bigger. Be BESA.
And now on to the podcast news. According to the new BESA Building Safety Act Industry Report of 2025, only 39% of micro and small companies even know about the Building Safety Act, despite SMEs making up 99% of the construction industry. If your business isn't prepared, you could be one of the 61% left behind. And now's the time to get informed, get compliant, and stay ahead. You can download the report from the BESA Hub on thebesa.com. On the 6th of November, join BESA's Ventilate Day exchange ahead of World Ventilation Day on the 8th of November. From tackling mould in homes to smarter commercial systems, it's all about collaboration and healthier buildings. Secure your free place via the BESA website. This November and December, BESA will host a series of member meetings with a technical focus. The BESA technical team will share updates on key industry guidance, including the DW145 revision, new technical bulletin TB59 on fire damper fixings, and progress towards the Heat Network Technical Assurance Scheme and HIU test regime. Secure your spot via the BESA website. So thank you for tuning in to Behind the Built Environment. If you enjoyed this episode, like it, share it, and subscribe on your favourite podcast provider. And don't forget to leave us a review. It really helps us reach more people across the industry. And for more in-depth conversations with industry leaders and the latest updates from BESA, stay connected and keep listening. Until next time, I'm David Frise, and this has been Behind the Built Environment. Goodbye.
Thanks for listening to Behind the Built Environment podcast from BESA. If you like what you heard today, then please follow and rate us on your favourite podcast app. Come and join us over on LinkedIn, BESA Group, and carry on the conversation. And if you want to find out more about joining the BESA community, then please visit thebesa.com to start your journey with us today.